72 hours. That's all that separates you from the most important date in the silver market in nearly half a century. February 27th, first notice day, the deadline when every single trader holding a March silver futures contract must decide, roll it forward, close it out, or stand for delivery. Stand for delivery means one thing: give me my silver. Not paper, not cash, physical metal. And here's the math problem that should terrify you. There are over 420 million ounces of silver tied to March contracts right now. COMEX, the exchange responsible for delivering that silver, has 93 million ounces registered and available, 420 million in paper promises, 93 million in actual metal. You don't need a finance degree to see this doesn't add up. But here's what nobody else is telling you. And I'll reveal this later in the video. This delivery crisis isn't just about COMEX numbers. It's about what's happening simultaneously in Shanghai, in London, and in the boardrooms of major tech companies who are panicking behind closed doors. When you see the full picture, you'll understand why February 27th could trigger a chain reaction that reshapes the entire silver market. Stay with me. Let me break this down. First, let me explain how this system actually works for anyone new to the silver market, because understanding the mechanics is absolutely critical. COMEX is the world's largest precious metals futures exchange. Silver trades in monthly contracts. 4 of those months are what they call primary delivery months. March is one of them. It's massive. First notice day is the deadline. It's when contract holders officially declare whether they want physical delivery of the silver their contract represents. Each contract equals 5,000 ounces. So if you hold one contract and stand for delivery, you're demanding 5,000 ounces of real physical silver. In a normal month, most traders don't actually want the metal. They roll their contracts forward to the next month or close out their positions and take cash. Maybe 3 to 5% actually stand for delivery. The entire system is built on one critical assumption. Almost nobody will actually demand the physical metal. They just want price exposure. But that assumption is collapsing. The data over the past 60 days proves it, and what I'm about to show you reveals exactly how broken this system has become. Welcome to MacroShield Method. If you're new here, hit subscribe and drop a like. It helps the algorithm push this information to people who need to see it. Thank you for being here. Now let's get into the numbers, because this is where it gets alarming. January 2026 was supposed to be a quiet month. It's not a primary delivery month. Historically, delivery volumes are minimal, but COMEX processed 51.2 million ounces of silver deliveries in January alone. Let me put that in perspective. In January 2024, the number was 6.9 million ounces. In January 2025, it was about 12 million. That means January 2026 saw more than 7 times the delivery volume of January 2024. 7 times. In a minor month. And it didn't stop there. Total COMEX silver deliveries for the trailing 12 months have exceeded 480 million ounces. That's more than double the previous year. Every single month has shown elevated delivery demand compared to the same month in prior years. Every single one. The trend isn't slowing, it's accelerating. And here's the number that should stop you in your tracks. February 2026, which is still ongoing, has shown a 97% delivery rate. Out of 18.4 million ounces of open interest, over 17.8 million ounces were called for physical delivery. 97%. In a normally functioning futures market, that number should be in single digits. When 97% of contract holders are demanding physical metal, you're not looking at a futures market anymore. You're looking at a physical allocation system where paper is converting to metal, and the metal is leaving. Now let me show you what's happening to the inventory, because this is where the math becomes impossible. In October 2025, COMEX registered silver stood at 164 million ounces. By early February 2026, it dropped to 98 million. That's a 40% decline in 4 months, but it didn't stop there. On February 14th, a single-day adjustment removed another 4.1 million ounces from the registered category. Registered silver fell below 95 million ounces for the first time since 2019. And eligible silver, the metal sitting in vaults but not yet offered for delivery, is draining too. Combined withdrawals over the past week exceeded 11 million ounces. Since September, COMEX registered silver has dropped from over 200 million ounces to under 95 million, cut by more than half in 5 months. And here's what's remarkable. Even during the January 30th crash, when silver fell from all-time highs near $120 down to $64, a 47% collapse in hours, even on that day, physical silver left the COMEX vaults. Over 3.5 million ounces walked out during the worst single-day sell-off in 46 years. The paper price crashed. The physical metal kept moving. That tells you everything about the disconnect between paper and reality. Now let me tell you what the mainstream financial media isn't covering. Because the COMEX story is only one piece of a much larger puzzle. The Shanghai Futures Exchange has been hemorrhaging silver. On February 10th alone, Shanghai lost 28 metric tons. Total Shanghai inventory has dropped to 298 metric tons, dangerously close to operational minimums. And there's a Chinese billionaire named Bian Shiming who holds a massive naked short position against that shrinking inventory. Over 30,000 contracts through his brokerage. That's approximately 470 metric tons of silver exposure against 298 metric tons in the vault. More contracts than metal. Again. Chinese regulators have reportedly frozen his ability to add to the position and publicly disclosed its size. Industry analysts are comparing this to the nickel squeeze of 2022, because if the market turns against him and he can't add shorts, the covering could send Shanghai silver prices parabolic. And Shanghai's depletion didn't happen in isolation. A significant portion of Shanghai inventory was shipped to London in late 2025 to cover delivery obligations at the LBMA during its own crisis. That metal was never replaced. The global silver market has fractured into three competing regions. North America centered on COMEX, Europe centered on London, Asia centered on Shanghai, and India. Each region is fighting to control whatever physical metal it can secure, and the metal is flowing east. It has been for years, but now the flow is accelerating. Here's why. China controls approximately 70% of global refined silver supply, and on January 1st, 2026, they added silver to their strategic export control protocols. Think about what that means. The country that processes most of the world's silver just made it harder to get silver out. Meanwhile, the United States just classified silver as a critical mineral and allocated billions for strategic stockpiling. Two superpowers, same metal, both trying to secure supply, and the exchange caught in the middle, COMEX, has 93 million ounces left. Now I need to address what happened on January 30th, because it directly connects to what's coming on February 27th. Silver hit an all-time high near $121 on January 29th. The next day, it crashed to $64 odd, a 47% wipeout in hours. Treasury Secretary Scott Bessent blamed Chinese speculators, called it a speculative blow-off. But look at what actually happened. CME Group raised margin requirements twice in 4 days. They switched from fixed dollar margins to percentage-based margins, 9% of contract value. That means as silver rose, margin requirements rose automatically. It became a self-reinforcing liquidation machine. Higher prices triggered higher margin calls, which forced selling, which crashed prices. It was engineered. And here's what the Treasury Secretary didn't mention. At the exact bottom of the crash, JP Morgan stood for delivery of 641 contracts. That's over 3.2 million ounces at a settlement price around $78 per ounce. The same bank that paid $920 million in fines in 2020 for manipulating precious metals markets was taking maximum delivery at the exact moment of maximum panic. And here's the technical detail that exposes the mechanics. Silver's implied volatility index fell 11% on January 30th during a 20% crash. That's backwards. In a genuine panic, implied volatility explodes as traders rush to buy protection. When implied volatility falls during a crash, it signals coordinated position unwinding, not organic fear, engineered liquidation. China responded very differently. They suspended 5 commodity funds. They shut down 6 trading entities. They reprimanded over 240 traders for naked short selling. Real regulatory action. The US CFTC has said nothing. Now I need to be balanced here because that's what we do on this channel. Well, let me be absolutely clear. I am not predicting a COMEX default. What I am telling you is that the data is showing stress levels in the silver delivery system that we have never seen before. Not in 2020, not in 2011, not ever. There's a counter-argument. Some analysts correctly point out that open interest doesn't equal delivery demand. Most contracts have historically settled without physical delivery. They're right. The question is whether February 27th breaks that historical pattern. Whether enough contract holders look at the inventory numbers, see 420 million in contracts against 93 million in metal, and decide they need to secure their position now. Because if 100 million ounces stand for delivery and there's 93 million in the vault, it becomes first come, first served. And nobody wants to be last in line. The nickel market showed us exactly what happens when delivery claims exceed available inventory. In 2022, nickel quadrupled in 48 hours when traders realized inventories had been promised multiple times over. The LME canceled 2 full days of trades. Billions in legitimate profits erased with a keystroke. If something similar happens in silver, the implications would be orders of magnitude larger. Silver isn't just a traded commodity. It's embedded in every critical technology of the 21st century. Solar panels, electric vehicles, semiconductors, medical equipment, 5G infrastructure, AI data centers, military hardware. A nickel default was a problem. A silver default would be a systemic crisis. And here's something most people don't understand. If COMEX or any major exchange hits a genuine failure to deliver event, it doesn't just affect the futures market, it triggers a credit event. For every winner in derivatives, there's a loser. If the loser can't pay because the exchange changed rules or canceled trades, the winner doesn't get paid either. Banks collectively held over 190 million ounces net short as of December 2025, according to CFTC data. Those banks need the system to hold. COMEX has another option, force majeure. They can declare extraordinary circumstances prevent delivery and settle contracts in cash instead of metal. But if they do that, it's an admission that the silver futures market cannot deliver silver, that paper and physical have permanently divorced. Every industrial user, every central bank, every government stockpiler would immediately accelerate efforts to secure physical metal outside the exchange system. A force majeure wouldn't end the crisis. It would intensify it. There's historical precedent everyone should know. In 1980, when the Hunt brothers were cornering silver, exchanges didn't just raise margins. They introduced Silver Rule 7, literally changing the rules so only sell orders were accepted, no buying allowed. A one-way market designed to crush the price. The current margin hikes, percentage-based calculations, coordinated fund suspensions in China, they're the modern version of the same playbook. Change the rules to protect the short side. But here's the critical difference. In 1980, there was no Shanghai exchange competing for price discovery, no China controlling 70% of refined supply, no critical mineral designation, no government stockpiling programs. The rule changes worked in 1980 because there was no alternative market. Today there is, and the alternative market is buying every ounce it can secure. Here's what I think is happening. The smart money already knows the paper-silver market is on borrowed time. That's why delivery volumes are exploding. That's why Samsung just locked up an entire silver mine through a direct prepayment facility. That's why Shanghai inventory is collapsing. That's why lease rates hit 35% in London. That's why the January crash didn't slow physical demand. The smart money isn't trading silver anymore, they're securing it. Citigroup published a note projecting $150 silver within 3 months. That was before registered inventory broke below 95 million. The supply deficit has run for 6 consecutive years. The world consumes 45 million ounces more silver per month than mines produce. New supply won't arrive for 7 to 10 years, minimum. The trend lines are converging, and they converge on February 27th. This is my analysis, not financial advice. Do your own research, make your own decisions. But the data is the data. 93 million ounces registered, 420 million in March open interest, 97% February delivery rate, 7 times normal January delivery volume, inventory cut in half since September, Shanghai below 300 metric tons, China restricting exports, US government stockpiling, 72 hours until first notice day. The physical market is screaming, the paper market is trying to shout over it, and in 72 hours, we find out which one wins. Drop a comment below. Do you think COMEX survives March? Physical metal, mining stocks, or futures contracts? Tell me your strategy. I'll pin the best responses. Share this video with one person who holds silver. Most people have no idea what's happening on February 27th. Most don't know registered inventory just broke below 95 million. Help me get this information out. If you're not subscribed, hit that button now. The delivery crisis, the Shanghai drain, the margin manipulation, the government stockpiling. I'm connecting the dots every single day with data and analysis you won't find anywhere else. This is Macro Shield Method. Protect your wealth, understand the system.